Maya, thank you for taking the time today to be on the Silicon Valley podcast. Now, I'm super excited to be here. We're recording live at the Sapient Impact Hub. Maya, I know your background. It's absolutely amazing. I did a lot of research before this interview. I'm very excited. But Mike, can you tell our audience a little bit about your career up until this point?
Yeah, sure. So let me set some context. So I've worked for approximately 30 years. And of those 30 years, I've worked at seven S&P 500 companies. And something to know for those who have worked in very large companies, they are like mini countries. They have their own culture. They have their own values. They have their own way of doing things, and it really influences how you see the world, and frankly, how what you don't see. And I think when we were talking a little before this podcast, I started thinking about things in my career that really were meaningful. And I was living in Palo Alto right off university, and I was working in San Francisco. I lived this hermetically sealed life. I had to be in, Wall Street hours, um, in the office, in my seat for meetings with London at a reasonable time. So I was getting up before 5 a.m., taking the first or second Caltrain of the day, get in the train. It's about an hour trip, walk to work, stay in there, maybe go outside to eat, maybe not, because I get food delivered, come back, get in the train. And that was my life for, many years. But on weekends, I'd get out, and I'm an avid runner, and occasionally I would find myself on El Camino, right, if you know the strip right between Palo Alto High School tennis courts and the Stanford soccer pitches. And there would be these cars there and vans, chock a block of stuff. And I'd go, that's a mystery. What are they doing there? And I'd keep going. And I wouldn't question it. I didn't know what they were. And I swear to you, the week that I left corporate America, I realized what those cars were. Those were people living in their cars. And it was so shameful to me that I thought of myself as a very open-minded person, and reasonably smart, that I would know what that was, particularly with a lot of the social ills that we have here in California, and particularly in the Bay Area. That did not occur to me, and I was seeing it almost every weekend as I go running. And so I decided upon myself, I wanted to have a career, my second phase of my career, something that would allow me to see, to be involved in the community, in my community, and try to make impact. That I'm glad for my corporate career. I learned a lot, but this was time.
Okay, so right then is when you had this epiphany and you said, okay, I'm going to start helping nonprofits or.
Well, I'm not. I have to say, it was I'm a more meandering type of person for my career. I started working for a small investment company. I'd been managing very large portfolios. Like my team, when I was working in the big asset management firms, I had a team that managed $200 billion of, large foundation money, large pension funds, sovereign wealth funds. And I really wanted to manage money where I could look the person in the eye. And my business partner today and I opened the West Coast office of a small boutique investment firm, and they were managing nonprofit money, small and mid-sized nonprofits. And they had individuals that they managed money for. They were in upstate New York. And it was that nonprofit, that endowment and foundation money that was interesting to us, and that here we knew we could marry our Wall Street experience, that Wall Street rigor, and bring it to small and mid-sized nonprofits that are not getting the high touch experience that our former employers would get. So if you're a multi-billion dollar foundation, you're going to get high touch from BlackRock or State Street, or and so we wanted to be able to provide that to the cat shelter that where the little old lady donates a couple million. There, that's pipsqueak for an endowment, and so it allows us to give that high touch.
Okay. I did like how you referenced animals there.
Yeah, I got more if you want.
So right there, you went from seven Fortune 500 companies. And if you want to mention them at all, just to name drop, you're more than welcome to.
Some were Fortune 5 too, but now they're kind of lower.
No one could guess any of those, let's be honest.
Am I allowed to be funny? Oh,
you could try.
I could try, but not as funny as you.
Okay, so now managing nonprofits' money, but there's this huge gap there. And what I mean by that gap is, Fortune 5, nonprofits. There's a pretty big span there, and your time here in Silicon Valley. I'm just kind of wondering about what you saw in this time. How did Silicon Valley change it all? Did it become less risk adverse? I know you're involved with Ostia Angels.
Right.
Sharon Bosmick was a guest on this show.
Yeah, thanks to me.
Thanks to you, actually. Thank you for that warm intro. Did things change in Silicon Valley over this time that you were seeing?
So I have to say, I've lived in the Bay Area on and off for, maybe 20 years, maybe more than that. And the second time I came, I have to say, I've lived in the peninsula for a long time, but I really didn't get involved in early stage companies and investing until about 6 years ago when I met Sharon. I brought her in actually to speak about investing in underrepresented entrepreneurs. And she said, come to one of our portfolio company events. And I was blown away that here were such inspiring people who were just not getting any venture money. It was just amazing. Like a woman through personal experience developed a medical device that was filling a gap on treatment for cancer, or Black entrepreneurs who have experience in social media who are building platforms that had music competitions and docuseries on African culture. These were cool things that were and cool products and services that, generations ago would never have gotten to time of day, and really needed an investor who, didn't have some kind of bias. And it was Sharon who showed me that, Silicon Valley is flying in the face today. The venture is not that meritocracy that we tell, that work ethic and skill that the money will come. And that in fact, the whole point, the whole investment model of venture capital was to find that diamond in the rough, that best in class, but that opportunity that nobody ever thought of. Well, today it's who's invested before. Is Sequoia invested? Well, if not, I walk, which really is kind of twisted. If I'm a public capital markets gal, so I quote Buffett, I guess, and he says, "Be afraid where others are greedy, and be greedy when others are afraid." And so, there are if you really believe in diversification of portfolios, you should also think about diversifying, where venture goes. And my interest in nonprofit money, it requires that I understand where these underrepresented uh, entrepreneurs are, because nonprofits want double bottom line. So for those who are not familiar with that term, it's wanting financial performance, but also delivering social impact. And so often, we'll have prospects or clients who say, "Hey, I want to invest in private equity. I want to invest in early stage start, but I want to invest in a woman founder. I want to invest in a Black founder. I want to invest in, trans founder." And so we've got to have that pipeline, and we have to know where these companies are.
So are you saying investing in a minority pool is actually diversification in an alternative investment portfolio?
You could say that. I mean, if remember that founders are people too, and so they are building companies based on their own personal experience. And so you look at you look at a lot of the just a woman founder is going to address a um, a need, a niche that reflects her experience. I think of a story I heard of a venture capitalist who had listened to some. It was a pitch day, and one of the founders came up with this shoe that was like $500, a woman's shoe, and he's like, "I'm passing. Women don't spend $500 on shoes." And so it's things like that. that I mean, I think on the other side, we need more diverse venture capitalists who understand that there is that market for that $500 shoe or whatnot. That there are customers to be had in a diverse services and product landscape.
Now, is that kind of the chicken before the egg thing? What's going to come first, the diverse venture capitalists or the diverse entrepreneurs?
Well, it's not changed at all. So I don't know. I mean, still 2% of venture is going to women. 0.5% of venture is going to Black women. So, and it's probably even less for Latinx. And there are a number of, nonprofits or initiatives that are trying to address this. ASTIA is trying to address it. There are some venture markets that are doing it better. I understand, Sharon will tell you that New York, they're saying, how can we find these underrepresented founders instead of they should find me. They should look the way I think they should. Instead, I need to change my mindset of what a CEO of a company looks. I have to be completely unbiased about what that looks like.
So you've had a huge career in the public markets.
Mm-hmm.
Right now, a lot of things in the news have to do around interest rates. How does rising interest rates affect Silicon Valley, affect early stage companies raising capital by chance or
By
no
chance.
correlation?
Oh, big correlation, actually. So for those not familiar, today within the last 10 days, Fed Chair Jay Powell indicated that the Fed would raise rates approximately 7 times to combat inflation. So you know why the Fed raises rates. It's basically like a splash of cold water on the economy, and it's the point of that is, and Powell believes this soft landing, but so that prices don't go haywire and we end up in a recession. So back to your question about fundraising for early stage startups. So raising interest rates basically is a killer for speculators. So, you know, many, you probably know this, but some of your listeners may not know this, but speculators don't just sit on piles of cash. They typically borrow money. And because borrowing money, you have a lot higher returns if you're going to borrow money. You can also lose a lot of money if you invest with borrowed money. Some will be sitting on cash. And so if their borrowing costs go up, then they have to scrutinize their investments across the board. And so an early stage startup is as risky as you can get. So if you have some cash or you have to borrow cash, you're going to look at that more closely, and there might be better opportunities for you to park your money until you see that the economy is growing and we go through this kind of uncertain times. And maybe it's infrastructure you put your money in, maybe it's real estate. So there's going to be I would guess a fair amount of competition among those fundraising for their venture. And if they use debt, that's going to go up too. But the whole reason that we raise rates is so that things don't get like they were in the early 80s, and where we have really high prices, but a lot of unemployment. So the hope is, and things look pretty good. Unemployment is really low, almost at record levels. Mask mandates and vaccine mandates are easing, but they're still, with Ukraine and inflation, oil prices still quite high. And who knows about how the new variant we're seeing in Europe. So it's a pretty uncertain time, I would say. Still, they're pretty low growth, but let's hope that this period we do have that soft landing.
From the big institutional investors, when they're hearing all these macro events, all these global events, how much is that weighing on their thoughts for the local, those alternative investments? You mentioned, they're scrutinizing it because, cost of borrowing might go up, those things. So there might be more particular, but don't they already have a certain percentage allocated for these more alternative, these more risky, these, funding VCs, funding, funds of funds, things like that?
I'll talk from an endowment perspective. Now, I'll do some kind of definitional. So an endowment, you probably heard of like a university endowment, like a Stanford endowment, which, it's like $38 billion.
And Maya, if you want to drop some names of where you've actually worked, you've been way too modest.
Oh, really? Okay. Yeah. So I will. I never worked for Stanford, but I'm just using them as an example. So, typically there is a strategic allocation, as you said, and an endowment is typically a donation from one or lots of very wealthy individuals or families. And this money is supposed to be there for a very long time. So to your point, these geopolitical events, macroeconomic events, fiscal events should not change the calculus. It should not change the allocation, because the whole point of asset allocation, strategic asset allocation, even at the big, Yale model, as they say for in the endowment world, or even, the smaller nonprofits that we're looking that have $10 million, it should be the same, and it should be even for your personal retirement. We'll have clients who'll say, well, what do you think about, what are we going to do if, Putin continues? I'm like, we're not going to do anything. We're going to do the same thing. You don't look at the price of your house every day on Zillow, do you? No. Well, you're not supposed to be looking at And the problem is, the stock market, you can see it on your widget on your phone every day. And that's kind of confounding. But it should not, they should keep that kind of allocation consistent.
Interesting. And you talked about endowments there,
Mhm.
nonprofits. I want to go back to you were in the private sector, now you're helping nonprofits. How come the kind of the management style, the way a business is run for the nonprofit, how come it doesn't, or for the profit, how come it doesn't correlate or spill over into nonprofits?
So, there's this, I guess, this arrogance of those who come from the private sector. Once maybe was sitting on a board and spewing some strategy, or you start working more closely with nonprofits. And I got schooled by a friend of mine who who has done capital campaigns, and her whole life she's done fundraising. And she said, you're just so typical. You presume that you can come with your business ideas and that's going to make nonprofits all better. But, you're not the first one to do that. And so, slap on the hand. And, it's right. It's just like, someone running for office, like, oh, I was in business. I could run, government like business. It's very different. It's the lens, really. I mean, there's a lot that nonprofits can learn from business and vice versa, and we're getting to that point. And I'll get there. I'll get there. Um, so so when you have kind of profit seeking motives, you can have some products and services that are good, have bring to the social good. So a nonprofit, a lot of people know the definition of a nonprofit, but they probably don't know why it's a nonprofit. So nonprofit receives a tax exemption from income, federal and state, if 100% of their income and their financial resources are to serve the public good. 100%. So no shareholders. Nonprofit doesn't mean no profit. It means there are no shareholders, there are no owners, that the profit goes back to them in a dividend. Now, if they should probably be in the in the black, because heck, there might be a pandemic or runaway inflation that they have to be prepared for. But that profit needs to go back into to serve the mission. Now, with profit maximizing, having that's exactly the goal, is to maximize profit. And so, you could see like the steam engine or the light bulb or drones. I just read recently there's a startup in England that is developing edible drones, so that for humanitarian aid, they will drop medical supplies and then you can eat the drone. So these are, profit maximizing, profit maximizing companies that are doing good. But, we have loads of examples of businesses that have led to economic inequality, to environmental devastation and waste. But it's really the lens. And so I was just reminded of an example this week of why a nonprofit cannot use profit maximization as their guiding light. They have to use what their mission is. So I'm a commissioner on the Commission on Status of Women for San Mateo County, and we had one of the development officers from Second Harvest Food Bank. They are responsible for distribution of food across San Mateo County and Santa Clara. And she said, and it's difficult being in food banks because they have two things that they are influenced. The price of food, which has gone up. We've learned that Ukraine and Russia are one of the top producers of food and wheat and grain in the world. So we're losing supply there. So classic economics. And then fuel prices going up. So they have found that to deliver food, their fuel prices are higher than the food they're delivering. Now, a business would say, heck, we're not going to deliver food, or let's pass on the fuel costs to the customer. You can't do that for a nonprofit. You got to suck it up. And you've got to monitor that, and because your mission is to solve world hunger or solve the community's hunger, and so that's why it's hard to do that. That being said, a nonprofit does want to maximize impact, so they have to be fiscally responsible. I mean, one of the reasons Catherine Earhart, my co-founder, and I got into this was we were working for BlackRock, if you want to name drop. We were fundraising for a small microfinance nonprofit. They were funding low-income women who were looking to start their entrepreneurial venture. And so it was microloans and grants. Great organization. We raised about $250,000 of our own money and our colleagues' money, and with the corporate foundation, we hand over those massive checks, and they had a gala. 2 weeks later, the nonprofit folded. It was so devastating to us, and it was through poor financial management. The nonprofit grew too quickly.
In 2 weeks?
Well, no. Well, that's another thing. I mean, that goes to the whole thing about how, does a board aware of what's going on in the operations? But we didn't think that should happen ever. So there are, fiscal policy or financial policies and procedures that nonprofits should put in to allow them to survive and thrive and be able to maximize impact. And they can learn that from business, and business learns a lot from nonprofits as well. I mean, we do have the certified B Corp, where nonprofit founders and for-profit founders are saying, hey, I want to do good for my community or for the environment or for society, and I want to have a different. I want ownership. I want to have shareholders, but I want to track my impact. And I just was listening to the radio, or talking about some young finance journalists were saying, they're millennials, and they're like, I don't care about globalization. I care about impact. I'm okay with lower growth if people are getting jobs, if people can feed themselves. We're coming into a different maybe era where making as much money as possible is not what people want, maybe what the next generation wants.
So you mentioned boards.
Mm-hmm.
Pretty common, I guess, entrepreneurial life cycle is found a company is successful, exit, not sure what to do, join boards of nonprofits. What should they know in advance of joining a nonprofit board?
Okay. So yeah, I actually had a few retiring Silicon Valley executives who somehow got my number and say, what do I do in my second phase of my career? And so let me talk first about kind of the structure of a nonprofit. A nonprofit has an executive director or a CEO, which executes on the strategy of the nonprofit and works on the day-to-day. And then, of course, there's this board that the executive director reports into, and the board is responsible for strategy. Now, if anyone, and being a member of a nonprofit board is a very enriching, very fulfilling fulfilling experience. And, I've been doing it for the last 15 years or so and sat on a lot of different boards. But I really think that you should go in eyes wide open into when you sit on a board. It should be a mission that you believe in. You should expect to open your wallet or at least fundraise for the nonprofit. You should also expect that bad things happen in nonprofits, and you should stick around. I have seen a lot of times where people will join a nonprofit board because they want to maybe network, or they think, oh, I want to be part of this. And they realize maybe there's fraud or there's some, yeah, I mean, there's conflict in the operations. And then they're like, well, I'm not sure I'm really the right person. I'm like, but yeah, boards in the private world, in the for-profit, you don't bail when the the company's going to. That's when you get to work. And so I think if you're thinking of joining a board, yes, do it, but realize that you've got to get to work. It's a lot of people used to think that the reason you sit on a board is to rub elbows with, and it can help your business. It's not that effective, frankly, if for networking. Yeah, it's great to meet new friends, but there are probably not many galas anywhere where you can sit at these $10,000 tables. There are a few of them probably in the performing arts, but it's really more about impact. And you're going to roll up your sleeves, and it should be something you really care about.
Going back to the idea that things are now changing.
Mhm.
Millennials, maybe it's not all about profit. Maybe it's about, impact.
Mm-hmm.
Are there more and more opportunities or different ways for nonprofits to raise funding now that maybe weren't there before?
Raise funding. Well, so let's talk about how a nonprofit comes to revenue. So there's the classic. So I don't know if I'm answering your question here correctly, but there's the classic individual donations. There is also government grants. There's private foundations and public foundations, and we have Silicon Valley Community Foundation, which is the largest community foundation in the country, that also grants out. You have earned revenue, which is like the Girl Scout model, with cookies and the like. But nonprofits are borrowing money. They're taking out loans. They are issuing social impact bonds so that you, Sean, could say, I really care about mental health. I want to buy a bond from a mental health nonprofit. I make a 2% return over 3 years, and they are able to build out a new facility. So I feel good. I get a stream of income, and this bond may even be guaranteed by a private foundation that really believes in this. And so they backstopping that nonprofit should they not be able to, so their credit rating goes down.
So, what happens when you have one nonprofit here, another nonprofit there? I mean, we're in Silicon Valley. There's nonprofits everywhere. One is we want to increase housing, and then another of, we want to save newts, and we don't want any more housing.
Right.
And they collide.
I see. Yeah. So that goes to the issue of you can't be a purist of all things kind of impact. So, for example, the we have a housing crisis here in the Bay Area and all over the country and in various pockets. And we need probably more denser housing and more affordable housing. But at the same time, that could impact the environment as well. And so there are a lot of kind of polemics out there about like which is more important, saving the environment and ensuring that we have cleaner air and not congestion, or do we have to compromise on that to pack more people into a town? You can't have it both ways. And it's the same kind of, we've had a number of guests who are in the area of ESG, which, yes.
For the audience, what's ESG? Just define it.
Environmental, social, and governance. And so governance being on how you run your company. And I would argue that ESG is a financial term. So social impact I see as more all-encompassing. That could be volunteering, that could be donating, that could be social entrepreneurship, it could be investing or lending, where ESG really is the belief that if I invest in companies or initiatives that protect the environment, address social injustice, and reward good governance, I will make money. But you will find that sometimes you can be way E, but not very S and not very G. So I think Tesla is a perfect example of, it's the epitome of E, low carbon footprint electric cars, but they have had hundreds of, I think there's a class action lawsuit about racial problems and racism within their employees. So that would not be an S company. So we'll often have clients who say, I look at the companies under the hood of this fund or whatnot, and I don't like them. I don't want to invest in Microsoft. Well, if you want performance, you have to have some of the high performing companies in there. So that's why being social impact, being ESG is such a, it's a Faustian kind of deal. And you have to be very, you have to realize you can either do it for values and that I'm not going to invest in these, or I'm going to invest in this company because I believe in it and I don't care whether I'm going to make money or not. Or, I'm going to be, balanced in my approach. And I recognize I'm going to invest in some companies that may not be, it kind of goes back to our other conversation that you've got to make a compromise. You just hope you're not making too much of a sacrifice.
Do you think all these new fintech companies out there, I mean, we're in a building of one more or less where it, automatic push this, automatic push that. How do you think that's impacting where investors put money when it comes to nonprofit or ESG, that area?
So
do you think it's persuading people in any way, or making it more people aware of it? Or
you're talking about like ESG and
with all these fintech apps where it's quick investment and it's the younger generation.
Okay. Well, I don't think of that as ESG. So this goes to just whether people should be invested in the market. I believe wholeheartedly that everybody should be invested in the market. when you look at, and this goes to an individual level, if you look at,
And this is not investment advice, right?
no, I'm not giving investment advice. No, I'm protected though. I've got my credentials. But anyway, if you look at research from, Fidelity or Charles Schwab, and you look at what the average that people have in retirement for every age, it's woefully inadequate. And we're probably on a fast train to some pretty tough times. But these robo advisors and platforms, it's great that it's making people more comfortable. My concern is that it's rewarding or encouraging people to speculate before they've even invested in the long term in their for their serious money. So you hear about Gen Zers who are taking a couple $1,000s and putting it in meme stocks, or the democratization of private equity through SPACs. And those things scare me because I spent 20 years as a risk manager, and for me, if I didn't understand it, and I had to understand these, I don't understand. I don't know how people who don't have this background feel comfortable throwing their money where they barely know anything. In fact, I'll tell you kind of a little story. So, and this is completely unrelated to investing. So I went skiing with my daughter. She was 12 at the time, and she's really into like snow parks. She's typical Gen Z or young Gen Zer. And I'm a really good skier. And she said to me, I said, "How do you do a box slide?" She goes, "Oh, it's really easy. I saw it on YouTube. All you do is go to the side." I'm like, "Go to the side?" And I'm looking at her and I'm thinking, I'm really a good skier. I can get on that box that's really slippy and get advice from a 12-year-old who doesn't ski and saw this on YouTube. I can do this. It was the most painful fall I have ever had. I mean, I had bruise on my face. You can see the video. I put it on our website, in fact, of what the dangers of using YouTube for advice. And I've had prospects who say, I follow this person, or I saw this on YouTube, and my stomach sinks because I'm not sure what's this person's background. Are they what's their deal that they're on? Are they here to educate, social impact, so that people will invest in the right things, or are they trying to sensationalize? And that, that's what really scares me, is that there is probably not enough balanced, good information, that there are so much noise out there that people are going to throw away their retirement or the little money that they do have.
And Maya, let's move forward. Let's just talk right now. What are you working on? What is Fairlight?
Okay. So Fairlight Advisors, we launched almost 3 years ago. And we were very intentional about giving investment advice, cash management, risk management, and financial consulting to small and mid-sized nonprofits. And so, as I explained before, small nonprofits that may, get that one-time donation from a major donor who's been giving a little, like $100 a month or even less than that, and then they pass and leave a couple million. we want to be there for those small nonprofits that wouldn't, need the education, trying to educate them on capital markets, on the economy, and really holding their hand and understanding also their spending needs, because nonprofits have to manage on very tight margins. As I said, all their profits need to go back um, into the mission. And so, how can they time, if they have a multi-year grant from the city, how can they ensure that all of their all the programs that they can fund, that they have enough money in that 5-year period that this grant is for, that they can survive. And so that's the kind of advice we're doing. So some of the new things for us on the horizon is one thing that's very kind of hard for those of us who are in that nonprofit arena, is it's very hard to find, at least for me, very hard to find other nonprofits or other professionals who serve nonprofits. We're very kind of niche-y, small group. In fact, it's the sort of thing when people say, "Hey, do you know so?" Yeah, I know that person. I mean, they're just not a very big group. And there's a nonprofit. It's kind of like a chamber of commerce of nonprofits in San Mateo County called Thrive Alliance, and I love the people there. And their executive director, Georgia Farouk, said to me, can you build a directory of professionals who want to work with nonprofits? And because she says, I know an accountant, I might know an IT person who wants, but I don't even know if they're good or not. And I said, hold that thought. Let me build my business first, and I'll come back to you. So today we're trying to build this directory for nonprofits to be able to find an attorney who focuses on tax exempt organizations, an IT consultant who wants to build their practice with more nonprofits, but also bring together people, whether it's a philanthropist or someone does sit on a board or wants to sit on a board, and maybe a public official or a concerned citizen, to come together in a kind of a speed forum, social hour, to talk about issues in our community, and do that so that they can meet like-minded people. Nonprofit people like to connect, but they're not typically networkers. Because we are always we're here to meet people, but we also have kind of a trying to find clients or connections, and there is a social point to it. So we want to bring that community together of nonprofits who wouldn't typically be able, nonprofit and social impact individuals who wouldn't typically come together in a forum.
And so, just reaching out to the audience, is anyone having any ideas as she's speaking right now about potential people to connect and bring together later? Just throwing that out there. And Maya, before we wrap up, I just have one more question for you. Your father, your mother, both entrepreneurs.
Actually, grandmother.
Okay.
His mother. Yeah.
What was the best advice they ever gave you? And then after that, if anyone wants to find out more information about you and what you're working on, what's the best way to go about doing it?
Okay. The easy one, fairlightadvisor.com. That's our website, and check that out. So advice from my grandmother, I wouldn't say. So I should say my grandmother ran a bookstore in San Leandro for decades. She was a badass. She was born in 1906. She graduated with honors at University of Oregon in the 1920s, which is unusual. She didn't drive, and yet she would commute from Berkeley to San Leandro for the bookstore. And then when she was about 70, she decided that her bookstore was not in an ideal location. So she moved the bookstore on the bus a few boxes at a time. Now, my father was a renowned economist in the niche world of like energy economics. And he was quite a bit of a Cassandra. He passed away in 2016, but he made a lot of predictions that people thought were crazy and in fact were very uncomfortable with. So this is kind of very pertinent to today. But in the late, as you know, kind of in the mid 70s to the late 70s and early 80s, the price of gas was astronomical. And I think it was like in 1980, it was like $135 a barrel. And academics, OPEC, even IMF, World Bank, they presume that oil would continue going up forever. I mean, that was the belief. And my father said, nope, it's going to crash. And he was one of the only people, and it sounds kind of, academic today, but no one believed him. He tried to get his friends to short oil futures. They would not do it. And I remember I must have been in about middle school, and I knew, you never know what your parents really do. You kind of find out later. And but I knew at cocktail parties or family parties, everybody's, Arlen, what's the price of oil doing? And I don't just leave, it's a boring conversation. But I asked him, why do people keep asking you that? And he said, well, because I think the price will go down and nobody believes that. So why? And he said, well, everybody thinks that oil is scarce. I believe oil is plentiful. I also believe that extraction and distribution of oil, the technology is getting better, so it'll be easier, and there will be alternative energy resources that will compete with oil. And this is like late 70s. And 1986, price of oil went down to about $35. A very good friend of my father's, who is very wealthy man, said that the worst investment decision he made was not listen to my dad. No one listened to my dad. And I think I've learned as an entrepreneur from him is that you have to be so convicted in what you believe. And it may not make you a lot of money, but it will allow you to sleep at night. And you may not make some friends and you at least be respectful. You, as he used to tell me, you respect everyone as if they're at least as intelligent as you are. But still you speak your mind. And it's probably the one thing that I will take away, that I will say what I think is right in a respectful way. And at least I will know that, I am the person I want to be.
And with that, we're going to end it there. Maya, I want to thank you for being a guest on the Silicon Valley podcast. For all our listeners, when you're listening to this on iTunes or any other podcast platform, please give us a 5-star review, leave a comment. It encourages us to create more content like this. For everyone out there, please connect with me on my social media channels. It's Sean Flynn, SHAWN, FLYNN, SV for most of them, or just Sean Flynn on LinkedIn. And everyone out there, while I'm not doing the podcast, I'm a mid-market investment banker focused on mergers, acquisitions, growth capital, and secondaries. And for everyone out there that didn't know, Maya is actually my mentor. She'll take zero credit for it, but she is.
No, I'm going to take a lot of credit for it.
And I also want to thank Sapiens for hosting us and allowing this event to happen, and our audience here today. And with that, Maya, thank you for being a guest on the Silicon Valley podcast.
It was my pleasure. Thank you.